Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, we're going to be focusing on the single metric to pay attention to when trying to understand Tesla, their value as a company, whether or not the company's overvalued, whether the stock's too expensive, too cheap, or somewhere in between. Now, I know there's going to be a lot of Einsteins in the comments ready to tell me the 400 quadrillion other things that apparently matter, but if we boil it down to one single metric to pay attention to, this is it. So with that said, let's get into the video. And by the way, since I know there's a lot of crypto lovers watching and people who like free stuff, it's your lucky day. For a limited time, you can get up to $250 in free crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. It also helps out the channel. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also using the link in the description. Let's get back to it. So here we are over on Twitter, reading a thread from Pierre Ferragu of New Street Research, who is one of the smarter analysts, actually understands Tesla. Generally speaking, if you're regular viewers of the channel, you know most of the so-called analysts covering Tesla have absolutely no idea what the fuck they're doing now. They may have specialization in a certain domain, but that specialization seems to be an impediment to them actually understanding Tesla. Kind of embarrassing, but just for the record, Pierre actually gets it. With that said, we're going to read through this tweet storm from Pierre because he makes some brilliant points, lays the case out as to why Tesla is an extremely rare, unique company generating huge amounts of cash flow and insane returns on their assets. As I said in the introduction to this video, this is the most important metric to focus on and one that most of Wall Street seems completely unable to even comprehend. So with that said, let's have a read. The long-awaited cash return on operating asset, tweet storm. Anyone interested in investing and evaluating the fundamental right to make money of a business should read this. Our research on Tesla's profitability is in this thread as well. What makes a right to make money? Your ability to 1. Invest some money into an operating asset. 2. Burn some cash to operate the asset. And 3. Generate cash from selling the resulting product or service in excess of the cash spent on running operations. A right to make money is more than a competitive advantage. It is a competitive advantage at producing something which meets a need, which is valued at more than your cost of producing it. This is profound, as Elon Musk would say. The best way to measure a right to make money? Cash return on operating assets. In other words, how many cents of cash per year can you generate out of $1 you invest in your operations? As simple as that. Now, I just want to take a moment to expand on this. The cash return on your operating assets means how much money are the assets you have that are actually operating, which means you filter out R&D expenses, new factories under construction, not currently producing vehicles, which are a drag on financials. You're just talking about operating assets. This is a great way to distill the fundamental financial strength of a company. This is one of those sort of stealth metrics that a lot of people can completely overlook and fail to understand. If a company is investing heavily in R&D, spending on this, that, and the other, it can get lost in the noise. And this is one of the core mistakes I think a lot of analysts and retail investors out there make when looking at Tesla. They're not noticing what's going on behind the scenes. Somebody today can clearly see into the future, go, holy shit, this is increasing over time. Wait, if this keeps increasing, holy fuck, Tesla's going to become one of the world's most profitable companies, period. Cash return on operating assets broke even at some point in 2018 with the ramp of Model 3, then went straight up to 20% in 2020. Please note this excludes credits. We don't care about credits, and this is 100% cash metrics. No possible accounting cheats, blah, 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 blah. Tesla's return on operating assets are heading in the right direction. And I'm just going to read the comments here. We read and hear a lot of comments about Tesla's profitability, or lack thereof. They usually happily mix considerations about gross margin, segment results, exceptional or financial items, regulatory credits, and rarely make sense. By the way, a round of applause for the low-key savagery there. Tesla builds factories to manufacture cars and sells them. As a result, the only appropriate way to evaluate its operational profitability is to look at cash return on operating assets. Out of $1 of assets immobilized in the ground, how much cash can Tesla generate in 1 year? The table on the left shows how this metric evolved in the last 5 years, breaking even and reaching 20% in 2020. This metric is bulletproof as it is only looking at operational cash. It cannot be tuned with accounting levers and purely represents the ability of Tesla's operation to generate cash. If you guys want to look into all the details, feel free to pause the video, but the only line that we're focusing on here, return on operating assets. In 2016, negative 2%. 2017, negative 3%. This is during the Model 3 ramp. 2018, after Model 3 had ramped, 10%. 2019, 10%. Remember, investing heavily, developing the Model Y, other products as well, and building out new factories. And in 2020, it's reached 20%. Now, let's just take a moment to consider what the fuck's going on here. In the span of just 5 years, we've gone from negative 2% to 20%. What do you think it's going to look like in 21, 22, 25, 30? Spoiler alert, it's going to the fucking moon. That's kind of the point. This is one of the benefits of being a long-term investor rather than a short-term gambler. There's a lot of short-term investors who've recently panic sold out of Tesla stock now. Oh, far out. The kindest way I can possibly describe the people that have done this, that have sold the stock recently, aside from those who had an immediate need for the cash, literally 100% of the people, companies, etc., who've sold out of Tesla stock at all, ever, I don't just mean recently, I mean ever, had no idea what they were looking at. This is one of those hidden metrics that if you really don't pick apart the business and understand it at a fundamental level, you can completely overlook. Key question is, how does that evolve over time? Two ways to look at it. Full utilization. What would Tesla generate with existing assets used at full capacity and incremental basis, i.e. additional returns generated on incremental capital deployed in the last year? Full asset utilization view. Tesla has on the ground enough assets to produce 1.05 million units. If we scale out that number to current economics, i.e. with today's cash cost per car and ramping working capital to that scale, Tesla would generate a 37%, one more time, a 37% cash return on operating assets. The incremental return view. What about incremental returns on incremental assets deployed in 2020? That is 90%, even better. As Tesla grows, returns will increase rapidly. Conclusion. Tesla is safely headed towards a 40 to 50% cash return on operating assets. Now, just want to be really clear for those of you who are kind of lost in the nuance, you don't really understand this. Let me explain. Effectively, what Pierre is pointing out here, for every $1 that Tesla spends in a single year, they've got to bring back 40 to 50 cents. This isn't the lifetime of the asset. It's not spend $1 and get 40 cents back over the lifetime of the asset. No. Every single year. In other words, 2 years after Tesla has invested $1 in building a new factory, etc., they've already made all the money back in 2 years. What even is this? Again, if you guys want to go into the nuance, feel free to pause the video, but the key is to focus on here, return on operating assets already around 37%. And with the incremental method, we're looking at a return on operating assets of around 90%. Pierre continues. This is the basis for our profitability forecast. We assume cash profitability is stable, car selling price minus cash costs going into the car, as Tesla passes on pricing efficiency gains, aka reduces the prices of their products as the actual cost to produce them comes down, which we know aligns with their mission. But as assets get better utilized, profitability and returns increase. So, let's be clear. Tesla can continue to drive the cost of their products down, yet their actual return on the capital deployed can continue to increase simultaneously, something that the Tesla Q dopes just seem unable to fathom. Of course, in the defense of these dullards, it's not that often that you'll find a company that can simultaneously drive the cost of their products down while increasing their return on capital deployed, but Tesla is one of these unique companies that can. We model over 40% cash returns in 2023. We expect Tesla to increase utilization and expand cash operating margins through efficiencies and leverage. Once again, pause if you want to see all the detail here. The key line to focus on, remember we looked at the 2020 return, we got a 20% return on operating assets in 2020. New Street Research are expecting that to approximately double in the next 3 years to almost 40%. How does this compare to peer premium car manufacturers? Tesla is definitely in another league. While BMW and Daimler struggle to produce cars that don't differentiate and get less wanted, their returns are under pressure, in the teens. Let's have a look at this chart. We've got a prediction here. This is where Tesla's at today. New Street's prediction, almost 40% by 2023. Look at the trajectory of BMW and Daimler here, heading downhill. Why? Producing internal combustion engine vehicles. Nobody really wants them. Tesla's eating their lunch. One great quote from this slide. This strongly supports our conviction that Tesla is manufacturing and selling cars in a way that fundamentally contrasts with the traditional auto industry. For example, the Model 3 and Model Y using a huge number of parts in common. Tesla go, hey, you know what? We can make the whole rear of the car in one casting. Wait, we can do that on the Model 3 and the Model Y and the Model S and the blah, blah, blah. Tesla is continuing to innovate, find new ways to produce their vehicles for less, and deploying this technology across the entire platform of vehicles. You might ask yourself, wait, why does Tesla only have the Model S, 3, X, and Y today when most other automotive manufacturers have 69 different models for sale? This is part of that big brain engineering and great leadership from Elon Musk and the folks at Tesla. They're thinking ahead. How can we drive these costs down? How can we have parts in common? How can we have common techniques for actually manufacturing and producing our vehicles? This is another great way to generate huge returns on capital deployed. Integrated manufacturing, uncluttered interior, direct distribution, and high software value add do make a difference when one looks at returns. This difference in financial performance increases the challenge for incumbents to invest in the electric transition and compete with Tesla. One last perspective. Why is Tesla so much more profitable than a BMW or Daimler? Every step of the operating model contributes. Check out for yourself. What we see here is the BMW EBIT margin at scale, around 7%. Now we can see stacked on top of this all the advantages that Tesla has due to their differentiation from this company and their business model. Tesla has a 3% advantage in terms of battery costs, another 3% due to direct distribution rather than using dealerships or dealerships, whatever you want to call them. They also don't waste money on paid advertising, another 2% advantage. Then of course, there's having this single integrated platform plus the software value add, another 5%, which creates a 20% EBIT margin at scale. We can see more here. Tesla today has around a 3-point advantage on its battery cost versus traditional OEMs. The pack cost is around 120 watt kilowatt hours, if not less, versus other OEMs at around $140 per kilowatt hour, if not more. And this is before Tesla's 4680 battery cells. Tesla distributes and delivers cars directly online with limited physical venues. This represents a 3-point cost advantage on traditional premium brands. Tesla spent 0.1% of revenue on marketing costs in 2019 versus OEMs at around 2%. Tesla already has a cult following. In fact, many of the people watching this video are part of that cult. Let me think about this for a moment. Is there a solving the money problem for BMW or Daimler or Ford or GM or Mercedes or pick your auto manufacturer? No. This actually matters a lot more than people realize. And any products released are well announced in the mainstream media. Tesla drives significant cost advantages through its product and production platform. Simple chassis design, uncluttered interior, highly integrated electronics, limited variation and options, unique manufacturing, automation, giant scale casting, etc., and value added driven by software, performance, autopilot, user interface. This concludes our thread. Cash return on operating assets is one of the pillars of the investment research we do. It is an excellent metric to understand how good fundamentals translate into strong financial performance. If you've made it this far through the video, congratulations. I know plenty of people fell asleep and have tuned out. I totally get that. But this is such an incredibly important metric to be focused on, and most people are completely asleep to this. As a long-term investor, aka the only kind of investor, it's not about today. It's not about tomorrow. It's about the future. And what we can infer about Tesla today, based on the available evidence, is that they're going to be a money printing machine. At some point in the near future, for every dollar Tesla deploys, in a single year, they'll be getting back 40, 50 plus cents. Next year, another 40, 50 cents. And now suddenly they've got a 100% ROI in 2 years. Guess what happens in year 3 and 4 and 5? Printing billions. Big shout out to Pierre Ferragu and New Street Research for putting this out into the Twitter sphere. I love this simple distillation of the most important metric in terms of understanding Tesla. Again, it's not about today. It's not about tomorrow. It's about next 2 years, 5 years, 10 years. If you're a smart investor and you're actually intending to hold this stock over the long term, you should be looking into the future based on all the available information today and thinking, how much cash can they be generating on their assets in 2023, 25, 27, 28, 2035? And for those of you who made it to the end of the video but got lost in a lot of the jargon, let me sum it up. Tesla today is already a money printing machine with insane returns on all the capital they're deploying. This is only going to continue to improve more and more until Tesla becomes not only the world's most valuable company, but also the world's most profitable company. This is inevitable. The writing is on the wall, yet most investors cannot see it. There is a reason that Tesla is practically the only thing that I've invested my cash in for the last 5 years. I began buying aggressively in 2016, I continued in 2017 and 2018 and 2019 and 2020 and still am buying today in 2021. I'm not doing this because I think it's a fun idea. I'm doing this because I can see this potential. I've never come across a company, an investment opportunity that's generating these kind of returns. Maybe in the future that will change. Maybe there will be some other companies that come along that can even do better than Tesla. But if I was a betting man, and I am, given the fact that the majority of my cash is both in Tesla stock and continues to go into Tesla stock, I give that pretty low odds. Let me know in the comments below if you guys found this video insightful. And also, do you think anyone on Wall Street besides Pierre Ferragu actually understands what's going on here? If so, drop a few names below. I reckon there's a couple of analysts out there that get it, but probably 90% of the analysts, maybe 95%, completely clueless to this fact. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. And don't forget, if you'd like up to $250 in free crypto bonuses with BlockFi, use the link in the description. You can also get 2 free stocks with WeBull and a free stock with Stake, also linked in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.